But in today's conditions, in today's environment, in today's constant globally spreading insecurity, particularly by those who are wealthy or who have a job in protecting wealth, or are wealth managers, gold cannot go, but carry on with its trajectory of the past decade. In every currency, in every country, and let's just pray. Let's just pray. I don't care how many shares of Barrick you have. Let's just pray that it's not going to go out of control. Let's just pray that gold does not jump up to $2,000 and $3,000 and $4,000. You don't want to be living in a country. You don't want to be living in a social structure where the overall lack of confidence in your government would have reached that kind of levels.
And we believe we barely scratched the surface on further potential investment demand. Relative to other asset classes, the gold market is quite small. The combined size of the equity, debt, and government debt markets at about $117 trillion and managed assets at about $40 trillion all dwarf the size of the gold market, which is less than $400 billion. So as a result, a small transfer of investment dollars to the gold market could have a substantial effect on valuations. Overall, we feel the positive story for gold remains intact and it has been reinforced by recent developments in Europe. Concerns remain about the unprecedented levels of government debt outstanding, driven by the accommodative fiscal and monetary policies of governments around the world. Countries have been left with the bills to pay which have exceeded 10% of GDP in some cases. We think global monetary and fiscal reflation will remain necessary for some time to come. Global imbalances remain, and excess global US dollar reserves appear to be concerning countries. These factors, combined with risk aversion over escalating sovereign credit worries in Europe, position gold to benefit as investors and central banks look for alternatives to the major currencies of the world.